Welcome back to Smart Stock Sam. And if you've been following this channel, you already know I called this setup before Friday's carnage hit. I told you the divergence was building. I told you the technicals were sitting on a knife's edge. And now here we are, SoFi down over 7% in a single session, 115 million shares changing hands, and every headline screaming disaster. But here's what I also told you. The price and the business were heading in completely opposite directions. So today, we're breaking down exactly what happened, why the smart money is quietly loading up while retail investors panic, and what you need to watch this Monday that could trigger one of the most violent reversals we have seen all year. This is not a doom video. This is a setup video. The question is, are you going to be on the right side of it? Let me give you the full picture up front. What we witnessed this week is what I'm calling the Great Divergence, a rare, almost impossible to time moment where technical chaos and fundamental acceleration are happening simultaneously. On one side, a stock that just snapped critical support, hammered by macro fears that have nothing to do with the company's actual performance. On the other side, record-breaking revenue, 9 straight profitable quarters, and a brand new crypto banking move no other traditional US bank has pulled off. And right in the middle, a set of catalysts starting March 1st that could light the fuse on a massive snapback rally. We will also uncover one hidden metric later that completely reframes what this stock is actually worth. And when you see it, it changes everything. But first, let's go back to the crime scene. Friday, February 27th. For weeks, $18.50 was the line in the sand. The moment we cracked below it, the bots took over. Algorithmic sell triggers fired one after another, cascading into a 7.02% crash that closed the stock at $17.76. At the intraday low, it touched $17.31. This was math-driven, emotionless, algorithmic destruction, the kind that completely decouples a stock's price from the business underneath it. And that disconnect? That is your opportunity. Now, you can't understand the magnitude of this drop without understanding the triple threat of macro forces that poured gasoline on the fire. First, the probability of SoFi getting added to the S&P 500 plummeted from 65% down to 43%. Everyone who bought for index inclusion hit the exit simultaneously. Second, looming 10 to 15% global tariffs began acting as a systemic anchor across the entire growth sector. And third, the real gut punch, a hot PPI inflation print of 0.5% obliterated any hope of a March rate cut. For a high beta fintech like SoFi, that combination is like pulling 3 fire alarms at once. But dig into the actual trading data, and you'll find the most interesting part of this story. 115 million shares traded on Friday, 87% above the daily average. But here is the detail that changes everything. Nearly 48% of that total volume occurred in dark pools and off-exchange swaps. While retail investors were panic selling on public exchanges, massive institutional block trades were being quietly executed behind closed doors. These entities were absorbing the sell-off, not fleeing from it, and the stock held just above the S3 support level of $17.44. That is not a coincidence. That is a floor being defended. So if the chart looks this ugly, why would anyone with real money be buying? Because the Great Divergence creates exactly this kind of opportunity. Retail panic and algorithmic selling drive the price below fair value, while every core business metric, profitability, user growth, and revenue is hitting all-time highs. We call this a dislocation, the gap between what a stock is trading at and what the company is actually worth. Let me show you the numbers. On the exact same week as this sell-off, SoFi reported its first ever quarterly revenue exceeding $1 billion. Let that land for a second. $1 billion in a single quarter. This is their 9th consecutive profitable quarter, posting a GAAP net income of $174 million. This is no longer a speculative fintech burning through cash hoping to survive. This is a banking powerhouse generating serious, recurring profit while the market treats it like a struggling startup. And then, on the very same day the stock was imploding, SoFi made a move that almost nobody is talking about. They became the first U.S. chartered bank to support Solana network deposits, opening a direct bridge for their 13.7 million users to integrate on-chain crypto assets with their traditional bank accounts. No other bank in America has done this. SoFi just drew a moat around a generational shift in how people manage money, and they did it while everyone was distracted by the sell-off. Could this crypto banking pivot become the single biggest driver of their next growth leg? I think the answer might genuinely surprise you. Now here is the hidden metric I mentioned, the one that reframes the entire valuation picture. SoFi is currently trading at a PEG ratio of just 0.6. For context, any PEG ratio below 1.0 is considered deeply undervalued relative to earnings growth. And we're talking about a 54% earnings growth forecast for 2026. That combination, strong growth plus a sub-1 PEG, is the exact setup that value investors spend years waiting for. The disconnect is so obvious that even Jim Cramer publicly called the stock a legitimate steal, saying it's simply too cheap to ignore at these levels. You are getting top-tier compounding growth at a bargain basement price. And you are not the only one who noticed. While retail was selling, Citadel Advisors increased their SoFi stake by a staggering 234%. JP Morgan Chase now holds nearly $500 million in SoFi. Sumitomo Life and Virtus Wealth both opened brand new positions this same week. Total institutional ownership has climbed to 38.43%. The very institutions writing Analyst reports are buying the shares retail is unloading. They are looking past the technical noise toward what this company is building long-term. The analyst community agrees. The average Wall Street price target sits at $26.34, implying over 48% upside from Friday's close. The bulls at Mizuho and Needham see this stock between $33 and $38. CEO Anthony Noto has pointed to a fair value in the mid-40s when applying standard fintech multiples to current growth. Even the bear case, Bank of America's target, is $20. Every single target on the board sits above where we closed Friday. Let that sink in. But here is the binary event that could spark the reversal as early as Monday morning. Anthony Noto's legal trading restriction lifts on March 1st. Historically, Noto is one of the most aggressive insider buyers in the market. If he steps in and purchases a meaningful block of shares, it sends one unmistakable message. The CEO believes the stock is undervalued. That signal typically triggers a wave of buying driven purely by momentum. And the options market is already coiled. Short interest at nearly 10% of the float, days to cover at just 1.9, with heavy open interest stacked at $19 and $20 calls for next week. A Noto buy could force a violent short squeeze, filling the gap back toward $22 within days. For those watching the levels, the aggressive entry zone is between $17.40 and $17.75, near recent lows and S3 support. For a confirmation entry, wait for the stock to reclaim $18.50. The psychological floor is $17 even. On the upside, resistance sits at $19 and $20.30. Break above that, and the path to the mid-20s opens wide. So here's the bottom line. Technical capitulation is meeting fundamental acceleration. The fear in this market has created a genuine pricing anomaly. Watch Monday closely. A Noto buy could spark the reversal and a gap filled toward $22. Without it, expect the stock to consolidate around $17.50 as the RSI resets from deeply oversold territory. The business has never been stronger. The price has rarely been this attractive. This is the great divergence, and the only question is which side of it you'll be standing on. Before we close out, an important reminder like always, nothing in this video is financial advice. Smart stock. Sam does not know your personal financial situation, your risk tolerance, or your investment timeline. Everything you've watched here is strictly for educational and entertainment purposes only. Markets are unpredictable, and even the strongest looking setups can move against you. Always do your own thorough research. Consult with a licensed financial professional before making any investment decisions, and never put money at risk that you cannot afford to lose. Now I want to hear from you. If Anthony Noto buys shares on Monday, do you think that alone is enough to sustain a multi-week rally? Or does SoFi need S&P 500 inclusion confirmed before the real move begins? Drop your take in the comments below. I read every single one. If this breakdown gave you value, smash that like button. It genuinely helps this channel grow. And if you are not yet subscribed to Smart Stock Sam, hit that button right now, because the setups we cover here do not wait around. I'll see you in the next one.